Hello, everyone. Today I'm going to introduce you to a very important type of option to master if you want to better understand market finance, binary options. In this video, I will only introduce you the cash or nothing binary option, but many other exist. The principle behind a binary option is very simple. If, at maturity, the price respects a certain condition written in the contract, then you win your gains. The condition can be, for example, that the spot price of the underlying closes higher than the strike price at maturity. On the contrary, if the closing price is below the strike price, you don't win anything and you lose the fees that you paid to enter the contract. The gains on this option are binary, hence the name binary option. For cash or nothing options, if at maturity the price of the underlying S is above the strike price, then a coupon is paid, the value of which is predetermined when the contract is signed. Here, the underlying is only a signal to trigger the gains. As you see on this graph, once the strike price is reached, the payoff jumps between the two prices. Now let's understand how structure and trader can create an asset with a payoff of this form. To understand how to replicate a binary option, you need to understand what a call spread is. A call spread is an option strategy comprising two call options with the same maturity but different strike prices. First of all, we go long of a call with strike price K1, as shown on the payoff plot. Then, we sell a call option with payoff K2 higher than K1, creating this form of payoff with limited gains and losses. Traditionally, we use this strategy to lower the cost of a long call by earning the fees of the call that we sell. As discussed in the previous video on gamma and theta, we can estimate an expected move of the underlying during the life of the option. Selling a call with strike price K2, whose value corresponds to the upper limit of the expected move, makes it possible to optimize a long call by reducing its cost. Call spreads are also generally used to trade volatility of the contract. Now, how to switch from this strategy to a binary option? To understand this, you need to understand how options leverage works. Let's plot three portfolios on the same chart, one with a single call option, one with two, and one with three, all with the same strike price and maturity. On this graph, we can see that what changes is the cost of the strategy, which increases the more options we buy, which is logical, but also the slope of our payoff. Looking at the three on the money portfolios, for a $1 increase of the underlying, the first portfolio yields $1, the second $2, and the third $3. So we begin to understand how to construct the particular profile of the binary option with an infinitely large slope. We need to buy a very large number of call options. However, to finance this call option purchase, you need to raise cash by selling another product. And that's why we use a call spread. The sale of call options enables us to finance the purchase of others, thus keeping the price of binary options relatively low. The formula shows how to construct a binary option. Note that in theory, the strike prices of the long calls and the strike price of the short calls are infinitely close. But epsilon doesn't just appear as an argument for the call's payoff. It is also inversely proportional to the quantities of call options bought and sold. When epsilon tends towards zero, the two strike prices are infinitely close, and the quantity of options bought and sold is infinitely high. In theory, to buy a binary function, you need to buy and sell an infinite number of call options whose payoffs are infinitely close. In practice, let's consider the following example of a cash or nothing barrier option with a payoff of 0 or 10% of the strike price. Here's how to construct such an option. There are several ways to obtain a 10% payoff ceiling. You can create a one-time leveraged call spread with options at 95% and 105% of the strike price at the money. Due to the slope of a one-time leveraged call, we take a gap of 10% between the two strike prices. We can also create a two-time leveraged call spread with options at 97.5% and 102.5% of strike price at the money. Now that the slope is 2, we only take a 5% gap. Or a four-time leveraged call spread on options with strike prices of 98.75% and 101.25% of strike price at the money. In all these cases, we obtain a spread of 10% between the two payoff floors. And this is how we derive the previous equation of replication. A explained before, if the underlying asset's price close above the barrier, the buyer earns the coupon. But to be able to trade a strategy, a trader has to know how to hedge it. You need to hedge your strategy to expose yourself only to the risks you want to take, and to do that, you need to understand how the Greeks evolved for such an option. We will consider delta, gamma, vega, and theta. For delta, it's easy to see that the payoff increases with the price of the underlying, so this strategy is always delta positive. As for the vega, when the option is out of the money, the vega is positive because a strong volatility movement would allow it to end up in the money, whereas as soon as the option is in the money, the vega becomes negative because a volatility movement would risk making it out of the money. For gamma, the option is always delta neutral, except at strike price. At strike price, we go from delta equals 0 to delta infinity, then back to delta equals 0. The sign of gamma is therefore positive, then negative in the vicinity of the strike price. We can also see that before the strike price, the payoff is convex, which means a positive gamma, and the portion after the payoff is concave, which means a negative gamma. For theta, we know that its sign is the opposite of gammas, as shown on the graph. But a way to understand it is that if the underlying price is below the strike price, then you would like to have more time to expect a move and reach the barrier. Then, as the remaining lifetime of an option always decreases, theta is negative before the barrier. But once you reach the barrier, you would like to stop the time and take your gains. In a situation when you want the time to decrease, you are theta positive. Because the variation of the remaining life of the option, dt, is always negative. Rho has a minor impact on the strategy, but its sign is mainly positive on the strategy. In fact, in this video, I detailed only one type of binary options, but it exists many more. The one described here is called high-low binary option. This type of option, as explained here, consists of asking, at expiration, will the price of the underlying asset be above or below the strike price? Once the decision has been made, all you have to do is select high or low on your broker and wait until maturity. But this is not the only type of option. One-touch binary options, which means that to get the rewards, the option price must reach the strike price at least once before it expires. No-touch binary options, which are the opposite. To reap the rewards, the option price must not exceed the strike price during the lifetime of the option. In the same vein, there are double-touch options, where the price of the underlying asset must pass through two prices, one higher than the current price and the other lower, in order to be in the money. Bouteries, which correspond to a double no-touch. And last but not least, the shortest term and the most dangerous, the short-term, or 60 seconds binary options. These options have become very popular because of their simplicity and the excitement they provide. But I strongly advise against trading this type of option. It is very complicated for a retail trader to effectively predict the price of a 60-second option, and in general, only the noise of the price signal is captured during such a short time frame and not a real trend. Before ending the video, I'd like to come back to a point that comes up a lot if you search about binary options. Are binary options a scam? My answer to this question is no, but some online binary options brokers can be and have been found guilty of manipulating their software to skew option gains. Of course, for a professional trader working in a hedge fund or investment bank, binary options represent no risk because the brokers are partners of the bank, and there is a relationship of trust between the two parties. However, because of their low price and potentially high leverage, binary options can lead gullible investors to believe that this is the financial instrument that can make you rich with a small amount of money. It is therefore essential to be well informed before putting money into a broker. But I do not recommend to any independent trader or investor to put a penny on such options. The goal of this video was informal and educational.